Yeah, super thick. What is it? What do you call it when like San Diegan? That would be an accent. What's a Connecticut accent?
You know, I think it's Connecticut, but I don't think that's accurate either. So I don't know. Lexi, do you know?
I'm originally from California, so I would just say Californian.
You know, I'm originally from here, but I lived in Boston for a year, so I wish I knew. I don't think we don't really call each other anything.
I always say that my
Connecticut, maybe.
Yeah.
What is it?
Connecticut Ian.
Connecticut Ian.
Adding as many vowels as possible. Yeah.
Yeah. Jeez. That's cool.
Yeah.
And you've lived there your whole life except for Boston for a year?
So I graduated college, immediately moved to Massachusetts, and then 2020, believe it or not, like 6 weeks before the pandemic, I moved back to Connecticut here. I was like,
no way.
I'm like, I have no idea. Like, I was so excited to see all my friends again and all that stuff, and they're just like, we're like locked in the house.
Yeah.
Perfect. Yeah, so let's just start to, take it away from here. Let me just start to share my screen. Perfect. All righty. Well, happy Friday, everyone, and welcome. Thank you so much for joining us for our webinar today. We're going to be having a nice panel discussion today. It's a very thought-provoking and timely topic on incorporating tax planning in your practice. Especially as we start 2024 and as we start the journey of 2024, the relevance of conversations around tax planning has never been more pronounced. The start of a new year presents a strategic window to proactively devise tax advantage pathways, which can go a long way towards alleviating the tax burden for clients. And in the dynamic landscape of tax planning, the ability to navigate discussions effectively and efficiently is always crucial, which is why we've established a distinguished panel of key advisors to lead this discussion. Their expertise is going to be guiding us through a comprehensive discussion on navigating these conversations and unraveling the intricacies of tax planning in a manner that is not only easily understandable for clients, but also empowers them with the knowledge to make some great decisions for their life. So we're going to be delving into these insights, and we're going to be talking about and taking a deep dive into the most common tax planning questions that can arise, ranging from questions on Roth conversions to looking at tax efficient strategies that we can take. And our panelists are going to be covering their different tips and tricks for when they're looking at preparing clients for having a more tax file ready mindset. So we're really excited to be having Derek and Warren joining us for this conversation. But one small note before we get into it, Derek and Warren are speaking from their personal experiences as advisors. If you're interested in adding tax planning to your practice, please make sure, as always, to consult a compliance expert to make sure that you're aligning with all the necessary rules and regulations. And so my name is Alexis Rogers. I'm the customer relationship lead at RightCapital, and I'm going to pass it along to Warren to introduce himself and provide some background for him.
Hello, my name is Warren Duthie, and I'm 41 years old, and I'm from California. I'm actually at the Great Wolf Lodge currently. You can tell by my wristbands. This is the Wolf Pass, and then this pass right here gets you, I think, free bowling and rock climbing. So we're here on spring training, and but I love RightCapital, as you can tell. I've got all the gear, and anytime I ask them for help so much when I dial that number and then I hit 2 for support, that anytime they ask me to help out, it's an automatic yes.
Yeah, but we're always happy to have you, Warren. Derek, do you want to take it away and introduce yourself and your background?
Sure. Derek Mazzarella. I'm with Gateway Financial Partners. I'm 38 years old, so nice. Not as old as Warren, so take that. I've been in the business since 2009 as a financial advisor. I'm located in Connecticut. And fun fact about me, I recently published a book, somehow got it through compliance last year. So that's one of my big accomplishments last year.
Perfect. Yeah, no, and it's always great to have you guys. We're always excited to have you guys for our webinars. We're really excited to leave this discussion. And of course, kind of just taking it away from our discussion today on the key points that we're going to be talking about. One of the first ones being that common questions that can pop up when we're talking about tax planning. Probably the first thing that can come up, and it's especially important for clients to understand, is the different tax buckets and how that can really have an impact in the long run, their tax exposure, the tax burden that comes along with those tax buckets. But Derek, do you have any insights on how you typically navigate those conversations, or what you typically see pop up when you're talking about the tax buckets? Because for non-financial advisors, tax buckets can be a foreign concept, of course.
Yeah, I think when you talk about tax buckets in general, to me, it's like we've got to make sure the clients understand the basics before we kind of move on to the more complex stuff. So I'll almost always go through tax buckets, and I think there's a few common misconceptions with it. So I'm very visual. I tend to use a whiteboard a lot. So I'll draw 3 typical squares. This may sound really silly, but I'll just drew like AT for after tax. I won't write out after tax because it takes a while. So like a lot of those little things, I feel like can go a long way. And I'm also really big on analogies, because one of the most common misconceptions I see, especially when it comes to tax buckets, is I'm sure everyone on this call that's a financial advisor probably got the question, well, what return does my Roth IRA get? What return does my traditional IRA get? And you're like, time out. That's not how they work. So the analogy I use is, think of these buckets as garages. So each bucket is a different garage, and the car is the investment. So the car can go in any one of the garages. It's just how they're taxed on the way in and the way out. That's the difference. So I think as much as you can keep the concept simple, because once they understand the baseline of how, the 3 main money types and how they're taxed, a lot of the other conversations moving forward tend to be much easier to understand and digest for the client.
Yeah, no, that's fantastic. Kind of insights when we're navigating that conversation. It's really important to understand those basics before you can even talk about tax planning, because that has so much to do with just the general concepts you're going to be talking about, especially as we dive into deeper discussions. Things like tax smart savings are one of those things that also pop up and are probably the most naturally occurring thing that would happen after we talk about those tax buckets and the tax burdens associated, is that conversation of how can we be a little bit smarter in what we're saving into for our path. So Warren, what do you typically see as common questions when we're talking about tax smart saving strategies, and what is your kind of tactic for that?
Well, I kind of know what it was like for the San Diego Padres yesterday in their very first spring training game against the Dodgers. At the first inning, the first half the inning, the Dodgers batted first, and they put up 8 runs, and we went through 3 pitchers. And the reason I say that is because that garage concept was so cool. I'm going to totally steal that and use it, Derek. That was really cool. I have 2 garages right here. Look, 1 and 2. You can, I need to get a third, I guess. But so I think to answer your question, Lexi, is the hottest topic that I've seen in terms of tax planning is just the idea of Roth conversions. And but before you get there, like I work with a lot of, I'd call them Henrys as an acronym: high earner, not rich yet. And so if there's a lot of cash flow that is being generated in our life, and they can save that cash flow, we can be strategic as to where to direct it. And we're kind of directing traffic there. Which garage should we start with? And so I love RightCapital because it gives you that picture of the tax brackets over a lifetime. So here I've got on the screen, you guys can see that, right?
Yep.
Okay, I've got Mr. and Mrs. Tax Bomb. And anytime you see this giant gap here where the effective tax rate drops off a cliff, and I had them making $400K a year, just 2 salaries, $200K a piece. And you can see that effective tax rate, and then just falls off a cliff. In my mind, the first thing that goes off is, hey, that's a ripe for some Roth conversions to fill in these low years and take advantage of it. And the analogy that I like to use, Derek, if we're going to have an analogy battle, is let's make some lemonade out of these lemons, these lemon years, which they're not actually lemon years. They're really good. But I think people understand that one of the most important ingredients in lemonade is lemons themselves. And so that might be shocking for some of the people here. But the idea there is for the tax bombs is to think about on the back end these unused years. And I strategically set this up with a ton of qualified money, IRA money, so that we could move a lot over. But I think that is probably not common. And then my favorite little slider in RightCapital is right there. Oh my goodness, it's the best. So we're just filling that in. And that's not revolutionary for anybody on the call. But one thing I do like to do, normally this compared to is set to pro rata. And it's sort of like when you come to this page, it spoils the punchline because if you're doing a Zoom and you come over to this page, it's already got an $11 million win on there, and they're like looking at that immediately. So I like to go and match them up compared to, so it's exactly the same thing. Then when I move that slider over, it's showing how amazing we are so far. And I like to just have that one at a time. So that's been my, I think when we're beginning with the end in mind, that is one of, not the only, and we might get into this later in the video, but that's one thing that I really, really dig. And I'm going to stop sharing now.
Yeah, no, those are all great points. And that's a great way to kind of highlight how there are resources out there for yourself as an advisor to have that information, that nice nifty tool, just using that slider to fill up the tax bracket, do that calculation of how much we can convert in a specific year is always great to alleviate that time burden that you might have been doing, hopefully not manually, but at least in RightCapital. But then there's also, we're going to talk on it a little bit later, those helpful visuals for when you are talking with a client, for when we're reviewing things like Roth conversions, and how that can assist in helping a client understand what you're saying. But there's definitely those great resources. Those are all really fantastic points to talk about Roth conversions and those different tax smart strategies you can take. And that kind of slider up above too, that compare to, is a great way to look at tax efficient withdrawal sequences that are applicable. But when we're talking about Roth conversions with that module, great point there. You want to make sure you're isolating those Roth conversions and not comparing different tax efficient withdrawal sequences. But all very important and very valid notes in terms of having those discussions. But, continuing that conversation of Roth conversions is a key thing, that is a key planning opportunity for a lot of advisors. Derek, what are your common insights or common questions that you see and you try to answer for clients when you talk about Roth conversions?
A lot of the time when it comes to Roth conversions and when clients kind of ask me like, hey, I've heard about this, like, what are they? And, what does it do? I think you want to take a step back and explain, hey, we're taking money that has not been taxed and is going to be taxed. So just really make sure that they understand that you are paying income tax rates and any money we transfer over. And also I try and make the point of, you typically have the option to withhold taxes. I almost never do that, because if you do that, it's counted as a distribution of the year and you could get a 10% penalty on top of that. So there's just one thing to make sure you keep in mind when we're having these discussions about Roth conversions. But taking a step back, I really generally see about 3 opportunities to make Roth conversions for most folks. One is when we go through a year like we did in 2022 and the market's down, everyone's freaking out. Sometimes it's actually nice to say, hey, look, the market's down. How do we take advantage of this? There's a typical tax loss harvesting conversation you can have. But the other piece is, what are we doing for Roth conversions? Let's explore that, see if that makes sense. It may not based on their income, but it could be a good opportunity, especially for a younger person, to say, hey, look, your account was 100,000, now it's at 80. Do we want to move 40 over or 30 over to a Roth and pay tax today? And then when the market rebounds, because our advice is always going to be, let's stay patient anyway. Let's get that rebound tax free. So that's a conversation I have. Especially if it's a business owner, they have spike years or down years income wise, or someone in sales. hey, like you may have variable income. Is this a down year? That's another opportunity. And just as Warren pointed out earlier, the third big one I typically see is when we have that U-shaped retirement, right? So that's always an opportunity as well for me to do it. Not going to get totally into that. But the last one I want to talk about, I don't think enough advisors are talking about, is the 2026 Tax Cuts and Jobs Act potentially expiring. Most tax rates are going to go up about 3%. So I'll kind of share my screen and show you what essentially that looks like hypothetically. So I've got this client, Winston Schmidt, CC. So we're looking at, okay, what happens if we make a IRA distribution? So we look here, they're on track for retirement, good. Their median outcome is going to have almost $5.5 million. But what if we moved, not 200,000, converted 20,000. So here you add it in here. We'll do it for this year and next year. So those are the last 2 years. We can do these conversions before the Tax Cuts and Jobs Act expires. Convert that to a Roth. Yeah, we'll look here. Now we're at, of course, nothing happens. Refresh that. We see the outcomes go up. If you go to the comparison tab, we'll see we're able to save this hypothetical person over $100,000 in taxes by converting 40 essentially over the next 2 years. And the other thing you can really show me, you really want to nerd out. I don't want to waste too much time, but if you go to the details tab here, it'll give you kind of a breakdown of where your taxes are paid, and you can compare it with, hey, what if we did nothing? So see, this year they paid, if they did nothing, they would have paid $25,000 in taxes. If they executed on the conversion, they would have paid $4,000 more in taxes. I'd pay $4,000 more in taxes for the next 2 years to save $111. That's just me. But then, you can also show them, hey, look, if we waited until 2027 to do this, you can go back in here. 7, we did 2028. You can show them the difference. Right? So you go back to the tax tab, details. Let's say that word. It's always one's better when you practice it. They'd say. Anyway, you get the point. So you can kind of go through and show them different scenarios where, based on my numbers, if they waited until after the Tax Cuts and Jobs Act, they'd be paying $13,000 more in taxes just by waiting 2 years. So to me, this is, when you look at the tax table here, you've got this window, these next 2 years, where you want to have conversations. Like I said, it may not make sense for everyone, but at least you should have these conversations with them about, does it make sense to take advantage of this now while we have this gap? I don't know what's going to happen in politics moving forward, but it's probably worth having that conversation with clients today about how we can take advantage of that.
We should totally go there. Go politics right now.
Yeah,
I'm just
Over here sweating. No, that's a great point to be making too. There is that nice long run picture where it makes sense for some clients to save more money over time, but then there is that tax burden we're paying up front. So that's a good conversation to be having, of kind of that eye opener of, we'd be paying a little bit more upfront, but we'd also in the end be saving money. But also if we're talking about like our ending assets and what our heirs are subject to. But it also is important to know with a software like RightCapital, especially when we talk about politics and the difference of the 2026 TCJA potentially sunsetting, there is the capability to set what you want to run with as your assumption, whether you want to assume that TCJA is going to sunset, or you can even show no sunset for 2026 and just have it continue with the current tax brackets that are applicable, or even have it be just fully for the 2017 pre-TCJA tax brackets. So there's a lot of different functionality that you can run with in a tool like RightCapital. So that's always an option to customize, but it is also important too of what the current picture looks like, and having that conversation of, does it make sense right now if we do consider that TCJA is going to be most likely sunsetting in 2026? What does that have an impact and for our different tax efficient or Roth conversion strategies? And so kind of talking on that end of life burden, Warren, what do you typically see commonly popping up when we're having those conversations with clients about what are my heirs subject to, or that tax at death? That's a key thing, especially for those that get closer towards the end of their life, of course.
Yeah. Well, one thing that just to like really get people focused on this stuff because it is so crazy. I think we should take a poll because I want to get this tattoo just to try to get people focused on estate taxes and or taxes at death. I got this out of The Economist. And so I just don't know if my skin color would really lend itself to a green skull like that. But anyway, the big thing that I've been talking to folks I have clients who are like in their 70s, 80s, and 90s. And a lot of them don't really fully understand how at death your assets get an adjusted basis. And they really, once they understand that their heirs aren't going to have to sell some of this, appreciated stock that they've had forever and pay a ton of capital gains, they are really, really pumped. And so what I like to show is this, a couple things. So this is the end of the road for the tax bomb family. And I like to just show them okay, look at the amount of tax deferred money you have at the end of your life. If you want to look at it in percentages, that's a great way to do it. The other way I like to do it is the account balance, because it sort of gives, if you are going to be doing Roth conversions, you can show them at the end of life what the amount in tax deferred is compared to, a scenario here. And the reason why is that, okay, now my heirs are going to have to, spend this money down. Like I have a client, she's in her 90s and her son is a partner at a major law firm and his income is crazy high. And her income right now is really low. And so Roth conversions, if she's like, look, I'm not going to touch this money one way or another. If we do some Roth conversions now, that's less that your son's going to have to pay massive amounts of tax on it. He already is paying massive amounts of tax. So I think that the stepped up basis, I'm running into a lot of people who have A/B trusts, which was popularized in the 80s and 90s as a way to mitigate estate taxes when the thresholds were a lot lower. And so the A trust, the survivor's trust, still gets a stepped up basis at death. The B trust does not. And I think one opportunity is to work with an estate planning attorney, and preferably the one who drafted the trust, to see if the trustee has the ability to transfer some of the principal or all, or have some kind of a plan to move it back into a type of account that does get a stepped up basis. I think that's, maybe with people with an aging book, they don't have a relationship with that next generation. That's a cool way to get in a foot in the door with that next generation and get all those parties at the table. If you can talk about plan and you can read the trust. And what I love to do is get them to upload the trust on the vault here securely. And then you can have that. And that also gives you the ability to kind of demo and flex the planning that you've been doing for their parents. And so that's one thing. I think another cool thing to tell people as it relates to taxes is, for if you have clients who are high income earners, I think what's such a crazy thing to show them. I don't know why my mouse isn't working here. It's just probably clicking in the wrong spot. Come on. Getting an email from Karen and now my mouse isn't working. Okay, comparison. Federal taxes paid. Here we go. This is crazy. The dollar amount here, 7.6 million bucks, 8.2. All right, what I was going to suggest is to tell people that they are not normal, okay? Because normal is I think it's 47% of taxpayers or people in the United States pay 0% in federal income tax. And so when you show them this, it's you're clearly not normal. And I think that the number is almost 2/3 pay single digit federal tax rates. So one, when you show them this, it's kind of like hey, you're not normal, and therefore we can't just take like normal strategies. We have to be a little bit more thoughtful about this. And I just pulled something for California. This is from the governor's budget summary ending 2023. This is crazy. So the highest income Californians pay the largest share of the state's personal income tax. For 2019, the top 1% paid 45% of all personal income taxes. That's a big number. And so anyway, I think that like this is just federal. So there's really a huge opportunity to go through and talk to them. One, when Derek was talking about the sunset of the Tax Cuts and Jobs Act, another cool thing that maybe instead of like, because you really don't only have so much capacity, like cognitive capacity in a meeting. Another cool thing to show them is like the amount of taxes paid, and maybe you do it in a Loom video. So I've been flexing on this software here, Loom, and it's just like you're sending them a little YouTube clip, and then that could generate like a cool call to action, like a call to a meeting. You might just want to talk to them about, hey, if we look here, your standard deduction, $31,000, but here in 2026, it's going to go down. Your deductions now could be 64 grand because it's assuming that now there's no more $10,000 cap on state income taxes being deducted. And in California, that's a big deal. You can go to Schedule A, and just, I guess what I'm thinking is like flex on them a little bit here, because I think like these are intimidating documents. A 1040 is an old, intimidating document. I don't think it's going anywhere. And so if you can demonstrate some familiarity around the document, you can pick out, like, I like this one here for those crazy years at the very end of life, the medical expenses, when the tax bombs are spending 2.6 million bucks on long-term care that year. You can see, like, look, the extent that's over 7.5% of your AGI is going to be deductible. So that's 1.4 million bucks. Pretty cool. And they're like probably not going to retain that, but it is like a little bit of a demo that you understand this stuff. Lexi, what do you think about that? I'm going to stop talking.
No, those are all fantastic points to make, especially when we're trying to decipher some of the heavier topics too. Taxes are something that a lot of people, unless they're actually tax consultants or CPAs, are not commonly used to, or they're not super familiar with. So it's important to be able to show those kinds of graphics and kind of either make it a little bit less mystified for clients, but also to have stronger conversations with clients about what's happening with their current tax picture, but in those future years. And so especially when we're talking about the Roth conversions and we're looking at those differences of the Roth conversions versus no Roth conversions and how that impacts our ending asset values and also total taxes paid, it's nice to have those easy to summarize visualizations for clients to make it a little bit more friendly for them to understand for sure. And you can also bring in those 1040s, those kind of topics of schedules and different things, AMT, if we're going to bring that into, or taxable Social Security, and how all of those nuances are going to be considered in the background, but it's something that you're familiar with. Is very important to also be able to kind of specify that you're familiar with the tax situations, and of course, always consulting with the tax CPAs if we're trying to get into the weeds about taxes, but just in general, having that familiarity with the tax situation, the sunsetting of different tax laws is really important to be able to flex on clients for sure. But all great points, Warren. Derek, what is your kind of take? How do you navigate those conversations, especially when we're looking at a software like RightCapital, when we're trying to discuss what is happening with our tax burdens, but also that other cost in retirement that Warren's kind of hinting at? That long-term care cost is one of the largest costs in people's life that can pop up, but also the secondary cost in retirement, which is just healthcare costs in general, things like Medicare. When we're talking about Roth conversions, a lot of times kind of key factor to consider is Medicare and how that might be impacting their Medicare expenses. So Warren, just if you want to shed some light on those kinds of questions.
Sure.
Derek.
I'm sorry, Derek. Yeah.
Well, first of all, I want to take a step back and follow Warren on the Loom videos. I don't use Loom. I don't think I'm with LPL. They don't allow us to do that. But I will record very often I'll get an email from a client like, hey, what if I did this versus this? And instead of writing out a long email, I'll pop on, go to the software, record a quick 3 to 5 minute video, like, hey, this is what you asked me to do. Let me run the analysis for the comparison, and I'll send it back to you. My feedback from that has been awesome, and I've actually found it really useful, especially if people are really busy. We kind of have this, not like, hey, we got to schedule an hour meeting. We'll just kind of go back and forth, so it's very much like on-demand meetings with them. And I found that to be incredibly efficient and direct with their answers. So I'm glad to see you already doing that, Warren. I just want to come back and second that. So let me go back and share my screen to get back to Lexi's question. I think one of the alarming things that I try and, maybe like one way I talk about my value to with clients is that, share the right screen here, that a lot of our planning is really interrelated, right? So anything we're doing is going to impact something else here. The nice thing about the distributions tab is that, if we go hog wild, I can say, hey, look, I'm going to pump you up here and we're going to save a ton of taxes. But then when you really do the math on it, now they're paying more for Medicare and their premiums go up. And, even if you go up just 2 Medicare brackets, your premiums double. So one of the nice, restrictions you can set on here is looking at, hey, I want to keep it to my Medicare bracket. And for some people that could be, really life-changing money, and some people it's not. Some people the bar is high or not, but I think you just really want to make sure you're having that conversation with them about it, because it lets them know that you're really on top of a lot of the small details. When you talk about, hey, when you go kind of the big picture of the tax buckets, you're saying, hey, look, all right, so you're retired, you're 7 years old, and just like what happened with COVID, everyone's in their house a lot more than they typically are. All of a sudden, you need a new roof, you want to redo your kitchen, that's a $50,000 expense, and all you have is pre-tax money. Now that $50,000 roof is going to cost $70,000. Oh wait, now you're in the next tax bracket. Now you're in the next farmer bracket. So you really want to talk about having different levers you can pull in retirement, and that can be one of the important things about planning for these Roth conversions earlier, or mixing and matching what you have from a tax bucket standpoint. So I think those things are really important. And then one thing I did kind of want to show you too, and the thing that I found is this tool's great. But sometimes when you leave the tool their own devices, they can be a little bit much. So what I found is, if you go to this edit tab here, you can actually select when the Roth conversions start and stop. And I found, even different situations, you could really actually save a decent amount of taxes and be more specific and saying, okay, instead of doing every single year, I'm going to do from when this person's kind of play with the buckets a little bit, 65 to, what does that stop, 73-ish? You look how look, all right, does that make the most sense? Just say, okay, you have more here. And then I always kind of go back and check the tax buckets. So you go back to the retirement tab. And this is not something I do in front of a client. It's just kind of more for you as an advisor. Just want to make sure you have your kind of playbook in your head, because I like to, I don't know, Warren, you disagree, but I like to do this stuff live with clients. And when I do it live, I kind of have this playlist in my head, because I want it to be a collaborative thing. I don't want this to be like our old school days where we just hand them a 90-page plan and say, okay, do this, do this, do this, do this, do this, and give me my money. This is not how we do it. So I'll say, hey, look, what happens if we do this? And I'll show them live. But you do want to double check your work. So go to the comparisons tab. You'll be able to say, okay, this one's 88,000. Okay, is that the right bucket? What if I play around with it a little bit more? Edit this again, go to just 70. Is that a better outcome for the client? So
Yeah, and that's what we're going to be making too, just to take a step back too. When we're looking at the distribution module, what Derek's saying, so that is going to be calculating where applicable, where they can fill up the tax brackets across their lifetime. So if we wanted to be more specific, we can say and have it end and start at specific time frames. So especially as Derek's saying, sometimes it makes more sense to limit it, or maybe clients aren't comfortable going to age 80 doing conversion. So you can specify that, control it, and see how that impacts the plan. And like he's saying, it might still make sense if they do that kind of different time frame of the conversions rather than across all potential years.
Right. So this example, when I read the full conversion, they would say 83,000 in taxes, which is awesome. But then when I constricted it down to from 65 to 70, they're up to 95,000 saved in taxes. So about $12,000 difference just by manually controlling things a little bit better. So, anytime you're running this software, you just want to kind of think in the back of your head, is there a different way I should do this? Kind of trust your eyes a little bit when you're seeing these charts and think, okay, what if I converted more later? If you convert too late on, is the benefit really going to be there? There may be an estate planning benefit, but there may not be the tax savings benefit. And that's where you have to weigh with the client. Hey, what's actually more important for you? Do you really just want to save as much in taxes now, or did you want to pass Roth IRAs compared to traditional IRAs on your beneficiaries? So those are the conversations you can have, and those are the things you can do in here when you're being a little bit more specific and targeted with this. So just don't run the kind of generic numbers, I guess is my point. Go a little more detailed and see if you can kind of target a little bit, just to play around and see if it makes sense. So that's probably what I would say when it comes to the tax tab here. Incredibly powerful, but you really want to give it kind of a back end look.
Yeah, no, absolutely. Derek, just one thing. If you can go back to the tax tab for me.
Yeah.
Let's go back into distributions.
Mm-hmm.
Under distributions, let's go to the details tab.
Yep.
So especially when we're having the conversation about when are we doing Roth conversions and how much are we converting, this details tab is where you can see specifically how much we'd be converting each year to fill up that specified tax bracket. That's one of the questions that was popping up, so I wanted to answer while we're here. But especially when you're trying to get that additional resource of what's happening, you can also see that gauge here. And if you're having a conversation with a client, like I said, maybe they're not comfortable doing conversions at age 80, maybe that's not right for them. You can also see here to see, are we actually doing conversions at age 80? Is that applicable for them?
Yeah, I'm glad you brought this up. This is a great thing to say. Hey, look, we can kind of more specifically outline your conversions, but this is where you really want to be careful too and say, hey, look, this is the conversation we want to have with your accountant. And so this is what we're projecting. Go ahead and double check that with that person, because we want to make sure everyone's on the same page, because they may be seeing that the software is not and vice versa, right? So we just always want to make sure we're paying attention to that. And this is where you want to cover yourself as an advisor, because, as much as we're talking about taxes today, you definitely want to make sure their CPA, their accountant is involved in this conversation, because especially when it comes to something like, I want you to convert literally $36,131, you definitely want to double check that with somebody to be okay with their account.
Yeah.
One thing that, I'm sorry, Lexi, didn't mean to
Go ahead.
interrupt. One thing to that point where you send them to the accountant, one thing that was totally off my radar was the fact that, so I had a client, she had like a pretty low income, taxable income, but she had a lot in, her taxable income was maybe $36,000 a year, and she had $500,000 in her IRA, and she'd just been an excellent saver for a really long time. And it was like, oh yeah, total no brainer. You should be doing some Roth conversions. When I sent her to the accountant, one thing the accountant caught that I didn't catch is that if she did, the threshold at which she would be converting would trigger a payback for her covered California health insurance. So it's like a federally subsidized health insurance that she wouldn't get. She would continue to pay low, but then it goes off of your income. And since we increase that income, she owes California back like $5,000. And I know that would not have gone over well. I mean, it's still, the math would have made sense. Like to Derek's example earlier, pay $8,000 to save $111,000. Well, okay, if you paid $13,000 to save $111,000, it's still a good trade. But a $5,000 surprise is not the kind of surprise I want to be giving a client. And so I think that really put some fear in me around, there's probably a lot of things that I don't see, even though I think I do. I don't want to get overly confident, and I want to make sure I've got the CPA stamp of approval going on there. Which one other question for Derek, and you know what, for all 206 people out there, have you guys been finding that CPAs are in shorter supply these days? I feel like post-COVID, the amount of CPAs that I can refer out has been at least cut in half.
I can probably anecdotally say that's true, and I think the ones that are a little more stressed out in terms of time, right? Hey, I'm super busy. I don't have time to go over everything with you. I definitely see that more. I'm even getting emails from my accountant at 10:30 at night. Dude, what are we doing here? You got to sleep at some point. So yeah, I've noticed that.
those Loom videos or those recordings, they probably love it too, because you can just show them, hey, forward this to your CPA. Here's what we're thinking. Is there any blind spots that we have?
Right.
Mm-hmm. Yeah, no, it's definitely all very, very good points too, especially when we're talking about those tax surprises. It's stuff that, we think we might be looking at, especially as financial advisors. You're looking at a lot of different expenses, and that includes taxation on things like mortgage interest deductibility, which we of course can reference and have a tool like RightCapital. But there are those nuances that are needing that special approval or that kind of compliance factor of having a CPA there to be that second set of eyes to kind of say, hey, in the background, if we do this, it's going to trigger all these different domino effects. So definitely important to always reference with the higher ups and the powers that be to make sure that we're all in line before we proceed with some of those deeper discussions on hopefully saving taxes in the long run. But if there's going to be immediate pop-ups, it's important to discuss as well. But as we're talking about being tax ready and the different aspects of what's going to be happening with our taxation, obviously we're in the midst of filing for taxes. The deadline's coming up in April, but Derek, what do you kind of do to kind of prepare your clients to have a little bit more of a tax filing ready mindset? Of course, barring that we're not CPAs or anything like that, but just how do you provide them for resources to get them ready as a financial advisor?
Yeah, well, there's kind of a few things I do. So the beginning of the year, typically mid-ish to late January, I started sending out this letter. It's a real email blast to all my clients. When to expect your 1099s. And I've got to tell you, as an advisor, I don't know how many people get calls. When's my 1099 coming? When's my 1099 coming? So once I started sending that letter out, I think my calls/emails asking that question dropped by about 80%. So I'm very proactive in saying, hey, look, you've got this account. It's expected kind of in this date range. And that's really been helpful. I also have a newsletter, and typically my January newsletter, I also lay out, here's some tax checklists that you need to go on. So make sure you're going over your children expenses for daycare, and go through a couple of common missed things that people have. And the last thing is you just kind of look at your book and say, okay, well, who hasn't made contributions yet for last year? Should I reach out to them and see if they still want to make anything? Are there any last minute tax moves we want to do? So those are probably the three main things I do to help clients get prepared for taxes. Yeah,
no, that's fantastic. And Warren, how do you also handle those conversations or prepare your clients for some of those big deadlines to consider, especially as we start 2020?
Yeah, well, we have like a calendar year deadline where we're having Roth conversion conversations in the beginning of the year with reviews, and just thinking okay, I want to have a better picture of what your total income is going to be before we actually pull the trigger on this, unless the spaghetti hits the fan with the stock market. And then in that case, we have this whole list that we're going to be proactively reaching out to everybody, recommending that we accelerate those conversations. So we have a calendar year deadline. Same thing with 401k contributions for solo 401ks. If there's money that needs to get in on a calendar year basis, we want to make sure we don't miss any of that. And so those calls are all being prompted to happen in October. Derek, in our prep, I totally stole that idea as well about the proactive, because we're just getting tons and tons of emails about when is our 1099. And, we've got them. A lot of times we can just send them out anyway, email them directly. Yeah. But I think to the extent that you can preemptively address something, that's better. So 2024.
So usually the last week of January, where's my 1099 coming? And I'm gonna be
I'm meeting with my CPA right now. Where's my 1099?
Oh yeah, tomorrow. Hey, tomorrow.
Yeah.
Yeah.
Always better to be proactive and get ahead of the curve, especially as those conversations. That's just always happening. Clients will always be reaching out saying, "Where's my W-2?" Things like that. When is that coming along? And the 1099 for what you might be managing, especially as an advisor. So all key things to be kind of getting ahead of the curve and just answering those questions. And it's also a great look to have a more personal approach too, to say, I'm already ahead of it. Don't worry about it. It's on its way. So especially if they're having a meeting with their CPA tomorrow, they can know that it's not going to be ready for tomorrow. It's probably going to be ready next week, probably. And this is going to be bringing us kind of shifting gears a little bit onto that final topic before we head into some Q&A, which is going to be that important verbiage when we're having discussions on tax planning versus tax advice. Are there any kind of tips and tricks when we're navigating those conversations, or how do you try to frame those conversations to make sure that you're stressing the importance, of course, as we've been doing this whole conversation, on consulting with CPAs for those bigger tax pictures? But, Derek, if you want to take it away and lead the conversation first to say how you typically frame that to kind of cover yourself in those conversations.
Yeah, I think you always have to phrase everything. Because if you really look at it, like almost anything we advise a client on is a tax decision. Whether it's, hey, you should save more in your 401k, you should buy a permanent life insurance policy, you should, like literally almost everything we touch is going to be a tax conversation. But I think it's important to outline, first of all, like, hey, we're not CPAs, we're not accountants. You should really double check everything we're saying with your accountant. But I think, when you really, as an advisor, thinking about the difference between planning versus like actual advice is more of or planning is more of a, what if we did this scenario? What if this versus this? You kind of show the different potential outcomes versus, hey, you should absolutely do this specific thing and like take this money out of this account every time. I know we are doing that, but that's to me like the real difference. And that's this side of the coin. We're saying, what if we did this versus this? You don't have to worry about a CPA, but I think it comes down to, hey, I recommend you take this much amount out. That's where you really want to double check with the CPA and say, look, double check. This is what we think you should do. Just make sure it's in line. And that to me is kind of how you should delineate it. I don't know, Warren has something different to say on that topic.
Yeah, it's basically the same thing. Preface everything. I'm not a CPA. This is not, just like if I was giving, talking about legal advice, I would say, disclaimer, I'm not a lawyer. And I don't give legal advice, by the way. But anyway, I would say that, the dream is if the three of us, you, your CPA, and myself, can get on a call together and figure this out. That way, and it's going to be really productive, and it's not going to be a bunch of emails crossing in the night. That would be the dream. And then I would also tell them, upload your 1040 from last year on the vault. And because I'd like to compare it with my software just to see if I can get better, more familiar with your situation. That's only going to serve you well. And then, so I think that also just grows roots in the relationship. If they know, hey, Warren has my 1040, he's looking at it. And we've had some awesome conversations with clients and their CPAs, or just one-on-one with the CPA. And the CPA gives us a glowing review. And that, I think, that carries a lot of weight with the client. And so I think you're going to get a ton of organic referrals from the client, knowing that you're legit. They've kind of been vetted by their CPA. And you might even get some from the CPA, just knowing, hey, this person is on it and they do what they say they're going to do. They understand how this stuff works. If they need to make a SEP IRA contribution, I know the right person to call that's not going to get me in trouble. But all that to say, never going out on the line saying, like, I'm going to prepare your taxes. I'm going to give you tax advice. But I say, in order for me to be a great advisor to you, I have to understand how taxes work. But that doesn't mean I'm going to actually file your return.
Yeah, no, that's fantastic. Especially when you have that context of what happened last year. A lot of times when we're doing that data draw from a client, sometimes things forget to be mentioned. Things like charitable giving goals might not be that conversation of, oh, I make a contribution of like $5,000 a year, might be not be something at the top of the mind. But having that 1040 from last year would also be a great way to reference to say, hey, we have higher deductions. What's happening here, and to see that it is charitable giving goals and be able to add that and incorporate it. So it's another way to also have that organic conversation, organic referrals, but also just to see if there's anything more going on that might have been not at the top of the mind in that original data draw from a client, for sure. So it's all great points. We got a lot of questions. I do want to point out, Warren, there's a resounding yes from all of the advisors saying that they are all also seeing that the CPA number is dropping.
So I wonder if there's an opportunity there. Like a non-TurboTax, I don't know. I know Intuit's making this push to try to get, people to, they have a CPA that's like accessible via, like a meeting like this. But it just seems like there's people are asking, do you have a good CPA? And it's like, man, not unless you're like really rich,
Yeah, another great question that we had is, are you paying for the CPAs, or is that hired from the client?
Yeah, the client.
Yeah.
thing.
Which makes perfect sense. Another thing too, if we just want to kind of backtrack a little bit into RightCapital, someone was asking how can we include the Roth conversions in that retirement analysis? So Derek, if you feel comfortable, if you want to navigate to the retirement analysis, let's show how to activate that distribution proposal and make sure that that's included in our proposed plan.
Yeah, you just go down here and see where it says distribution strategy instead of saying current.
Hold on, share your screen.
Oh. Rookie move here. It's my first time. Yeah, you just go from distribution strategy. You didn't set the current. You just did distribution proposal and then hit refresh. It's pretty simple.
Yep, and then you'll see everything that we were working on in that distribution module. If, for example, you were proposing that they follow a different tax efficient withdrawal sequence, meaning what buckets are we pulling from when we run into negative net flows and needing to pull from our assets, that would also be brought here as well. So if we were illustrating them going through a different tax efficient withdrawal sequence or those Roth conversions, that distribution proposal would be how you can bake that into your proposed plan and run that comparison versus the probability successes. So it's a really great question in terms of how do we illustrate those impacts and also make sure we're activating it in the proposed plan.
Yeah, just make sure you go to the capsules as well to just double check they're actually doing it. So that's one thing I recommend as well.
Perfect. A lot of really great questions, a lot of glowing reviews as well, especially with the CPAs.
I have seen some firms pay for, like, they have an in-house CPA. I don't know if it's like a profit center. It's more of just a nice to have.
100%. I've seen that a couple of times too, but it's definitely one of those things that with the number of CPAs going down, it's definitely probably a little bit harder to find a CPA that you'd be having a partnership with. And if you want to just go back into the distributions tab, Warren, you can feel free to do it, or Derek, if you're comfortable going back into distributions, just to walk through the action items there and what we can change one more time.
Or do you want to do it, or you want to do it?
I can do it.
Go ahead.
So got a couple questions here about the action items, and this is that distribution module. This focuses on either or both, looking at different tax efficient withdrawal sequences and what might be most relevant for a client, as we kind of discussed earlier, and also filling up the tax brackets as well. Done in step number 2 under Roth IRA conversion, and this is something Derek also mentioned as well, we can either stay with the default, which is ordinary income tax brackets, and filling up those tax brackets via Roth conversions. But you also have the option to fill up to cap gains tax brackets, and also that conversation about Medicare, if we're considering the impacts, if that's a key concern for a client of not triggering an income related monthly adjustment amount, that's probably when we'll be looking at Medicare premium tax brackets as the option for Roth conversion. But another question that we had was regarding the estimated terminal tax rate as well. That's another feature that you can have, that you can use as that conversation piece if we're talking about what are my heirs inheriting at the end of my life. If we're concerned about what's happening, like your example of somebody's son having a really high income, they're definitely going to be having a little bit of a higher tax rate when they inherit those assets. This estimated terminal tax rate is referring to that tax rate that the heirs would be subject to. This is only going to be impacting the conversation here in the distribution module, but it can be leveraged to lead that discussion of, if right now we have a 15% estimated terminal tax rate applied to those taxable assets, tax deferred assets, this is what it looks like if we did these Roth conversions versus not. But if we increase the estimated terminal tax rate, you would show those impacts of how much more, hopefully, you'd be having in tax adjusted ending wealth if you actually did Roth conversions, for example, and had more in the tax-free bucket. So that's going to be one of the nice nifty aspects here for when we're having those discussions of what is my heir inheriting. That estimated terminal tax rate can further that discussion, or just be that piece of you're really concerned they are going to have 30% tax rate, or maybe if they're earning high enough, a little bit higher than that. And that's going to be a key factor to consider when we're talking about any of these tax factors for especially Roth conversions. So it's a great.
Oh, yeah.
Yep.
That's cool.
This is especially true if you actually want to go to comparisons for me. This is going to isolate it. So if you go to the comparisons and we look at this side-by-side comparison of that ending portfolio value, when you adjust that slider, you'll see that these numbers will change drastically, especially as we have more in that tax-free bucket. For that left-hand side.
This one from 69 to 66.
Yep. And that's
crazy.
on the right-hand side, it goes down. So it's a huge factor when we're talking about what's going on with the errors. Like I said, this is only impacting this particular module, but it's a great space to have some powerful visualizations for those conversations about what is my heir that's extremely wealthy, which is great. What are they going to be subject to, and what is their tax burden if we're not putting things into trusts, of course. So it's a great question. Perfect. Another great question that somebody asked was the ending portfolio that we're looking at both there and later on, is that in future dollars or is it in today's dollars? So when we're looking at the distribution module and we're looking at those comparisons tabs, those are looking at future dollars always. This is pulling from one of the gauges of financial well-being, which is the capital projection, which is a straight line projection. It's a guaranteed return, so it's got growth accumulating. That is a future dollars number, of course. It would be nice if it was today's dollars and that was our actual wealth. But if we go back into the retirement module real quick.
It would be cool to see that it have the button today's dollars and future dollars, especially for like the total taxes paid. If it did a discount of all that, that would be really cool.
Yep. And so that's actually possible here. So right now we're using future dollars, but at the bottom of your screen, there's a toggle to today's dollars. So if you wanted to see what it looked like here for those other gauges of financial well-being as well, we can show here what's happening in today's dollars. You can see what that looks like for what we're looking at now, which is the probability success pulling from the Monte Carlo simulations. And it's the percentage of those 1,000 trials of market volatility that make it to the end of plan without running out of money. And that median chart right there is just showing that median trials ending asset value. So you can see what the Monte Carlo simulations look like in today's dollars, but you can also look at these other sub tabs to see what today's dollars looks like for those figures as well.
Lexi, is there, just while we're on the topic, is there a way to get today's dollars? Like if I was asking a question in the question thing, I would be asking to the awesome developers at RightCapital to say, can we make a today's dollars and future dollars button here too?
Yep. So it's currently not possible. As you can see, it's not there yet, but it is certainly something pass along to our fantastic development team. One of the great things with RightCapital, as you guys know as well, we're constantly rolling out a lot of really innovative updates. So especially if you guys have feedback like this, it's a great opportunity to connect with our fantastic support team and let them know what you want to hear. Obviously, you also have me right now for any feedback, but it's a great point to be making of having that additional lever for those conversations, for sure.
It's unbelievable how many updates you guys are pumping out, like on a weekly basis.
Email. Yeah, there's always something new that's coming out. We're always looking to enhance the software for sure.
Cool.
You have a great comment. Somebody said, I love the Mr. and Mrs. Tax Bomb. Can I steal it as an example?
100%. 100%.
Perfect. A lot of really great comments, a lot of great feedback too. And this is a great question as well. So somebody asked about when we're covering that 1040, how do you lead that discussion? Because it's obviously a good thing to just to note in general. It's not a real 1040. We're not pulling from what's going to be happening in the future. It's just a mock-up of the 1040. But how do you have that conversation with clients about and kind of that phrasing, as we're talking about, phrasing is important here. How do you phrase that conversation of we're looking at a mock-up? I'm sure you probably say it's a mock-up, but is there anything important that you mentioned to ensure that we're letting them know it's a mock-up of what the future might look like, but there are those nuances to compliance and of course CPAs?
Yeah, I think I would just tell them like, hey, this is obviously isn't your 1040 that you're gonna print and submit or e-sign. But the system is so robust that it has the numbers for most of what's going to actually go in, and it's going to prepare the 1040. So we can actually be really precise in comparison to other tools, which is why I use this one. But just to be make sure that I don't miss anything, I would love it if you can update or if you can upload your actual last year's 1040 to the vault here so that I can put them side by side. I want to see if there's anything that's stands out that is in a blind spot. I think that if you can get the 1040, you've got a really good client.
Perfect. Yeah, no, it's a great answer to that. Another question that we have, what is your approach when we're talking about backdoor Roth contributions? Or do you guys talk about those kinds of savings topics? Or when you're talking about tax smart saving strategies, what are those kind of saving buckets that you kind of fall back on in those conversations?
Yeah, I mean, I've definitely brought those up. I think the one thing you want to watch out for is there's definitely a few pitfalls. So it's just not like an end-all be-all that we should automatically do it, especially if they have IRA dollars. Got to beware of the pro rata rule. To me, I think that's something that if they're trying to do a lot of that on their own, they're may not be filling the right forms, so they want to make sure they're doing that correctly. So that's where I would generally lean on making sure they had an account if they wanted to execute that. But it can be a nice way, especially for someone that's already, filling a lot of the other buckets, the way to get some Roth dollars, in their lives.
Yeah.
One thing that is like it's you have to put your money where your mouth is on this one, because if you say you're a fiduciary, this is an option, is to take that IRA money and roll it into their 401k. And I think that's kind of a cool thing to do, that you're demonstrating it's not all about me. And especially if you're not managing the 401k, is now because of that pro rata rule, I would acknowledge that to the client and just let them know, like, hey, this is me trying to be a fiduciary. And if we were in, if the roles were reversed, I'd want you to tell me about this. And this is going to cost me, because this is IRA money that we could be managing. And I think you should do that. And here's why. You can even go through the differences and show them how much more money they're going to have just by doing that, backdoor Roth contribution. That's pretty cool.
Yeah, no, 100%. Another great question that we have is regarding the conversation of tax efficient withdrawal sequences, but also what the current standard is for our withdrawal sequences. Derek, if you want to, or even Warren, if you wanted to share your screen just to highlight how we can set what our current plan's withdrawal sequence is. So especially, for example, the default is typically taxable, tax deferred, tax free, but there are certainly circumstances in which we might need to be making adjustments for clients that are taking a different approach. Or if you're trying to highlight the difference of if this is our approach currently, if we're looking at the distribution module, you can see that impact. So Derek, if you can just navigate a little bit further up on your screen and go to the gear icon for me.
Yep.
Let's go to settings. And then here under methodology, this is where you set those kind of assumptions for what you're running with for your planning for those future projections. One of those being that withdrawal sequence. Second one down on the left-hand side is where you can navigate between all the different withdrawal sequences that are available. This is how you can say the standard for the current plan, that baseline, and also see what's going on with the current baseline plan for a withdrawal sequence. But that helps that conversation too, if you are trying to obviously reflect what's truly happening for a client plan and what their current path might be. You can make that adjustment as necessary, but then you can also come into here to show and make comparisons between those different tax efficient withdrawal sequences. So you can have the current plan be accurate, but you can also have this kind of more safer space to just play around with different comparisons of tax efficient withdrawal sequences. So it's all different functionality that you can do to have that conversation about what is actually happening versus what do we want to see happening for tax savings. So it's a great question there.
When you make that change, it just does it for this plan, right? It's not a global change.
Yeah, it's a great question. So anytime you're in a client plan and you go to that gear icon settings section, you are accessing just this particular client's settings. So this is a way that you can, of course, you need to make everything customized to a single client. And that rings true when we're talking about those settings and those planning assumptions. So you can make those decisions here for this individual client. And in each client plan, they have their own unique set of methodology and setting assumptions that you can toggle. The same is true if we're talking about those tax assumptions with 2026 TCJA. Anything like that, you can customize per client as needed. So it's a fantastic question, Warren. Another question while I'm reading the other questions for you, Warren, what is your favorite water slide?
Yesterday was the wolf's tail. It's the one, it's so crazy. And so you stand in this tube and you're standing on this platform that's transparent, and this cockpit canopy comes over you, and then you hear 3, 2, 1, and then the bottom falls out. And I was trying to get my 11-year-old daughter to go on it, and I couldn't believe she actually was like, all right, I'll go. So I was like, do you want dad to go first? And she's like, yeah. And I was like, you know what? Part of being like the coolest part about being father is seeing your kids like in these different scenarios. And I was like, wait, no, I want you to go in front of me so I can see your face when you're in there, and when it drops out. Like, I'm gonna never forget that moment. So just another piece of advice, I know you probably want to go first, but you're gonna want that image of your 11-year-old daughter about to go down first. So but yeah, the wolf's tail was for sure my favorite.
Yeah, no, it sounds like a blast. The Great Wolf Lodge has been my bucket list for a long time, so hopefully I'll also be able to join you on having the time of your life for the Great Wolf Lodge. Another question that we got, this is a little bit more tax-based, of course, but when we're looking at, especially if we have that past 1040 and what's happening in the background for previous years, how do you take that information and do you adjust anything in terms of tax assumptions? So just taking a step back for a second too, tax assumptions, you can indicate what's happening for portfolio turnover and what you want to run with for your assumptions across their lifetime, just for the audience. And you can set the assumption for what is qualified versus ordinary dividends and things along those lines. So just some backstory for the advisors on the call, if they're not familiar with all those different nuances available in that tax assumptions tab, there's a lot that you can adjust there. But what do you do if you see in the previous years and last year, for example, if we had a lower turnover versus some years? How do you take that information? How do you adapt it? Do you change anything, or do you run with like the same assumption that you might have done before?
That's a challenging question globally. Because I think you have to look at it when it comes to, is this something that's going to be consistently recurring, or was this a one-off? And I think if it's more consistent, then you adjust. If not, then you say, look, we're just going to go first. Because I mean, you can drive yourself crazy with all those little details at the end of the day. But I think that's how I approach it. What do you do?
Yeah, that's a great take.
Yeah, I think you can use it and just be like a Sherlock Holmes and be a little detective and look for things that jump out at you, and you can ask questions about it. Like, yeah, if there was a huge capital gain or if you see capital loss, you can ask where it came from. I think one thing that's kind of neat is you can look at the interest income and see like, oh, is there, if you have the 1040, you probably also have the statements, but maybe you don't, or maybe you don't have all the statements. And I think that could be one thing that's like, aha, and the client is probably you're going to get some respect for finding it. But you could think about having a conversation of, hey, you have a money market account or you have a savings account that's getting taxed at state and federal levels. And in California, by the way, there's big state income tax. And so we could maybe position that to just be in a money market account that's got federal securities only, so it's exempt from state income tax. That's a huge value add. And then while we're at it, what if we invested some of that money? It segues into things, but you can find stuff like that. Or, hey, where did this $900,000 loss come from? Or did you lose a bunch of money in crypto and you're too embarrassed to talk about it? I would be too. I get it. But you can at least use those losses. Anyway, I think those are good things. You can see depreciation. A client may not know how much is left in the depreciation tank on a rental, and now you can find out. I think there's a lot of areas that just little clues you can look for that can enhance your conversations.
Yeah, you definitely want to make sure you're using the carryover, because that's pretty easy to kind of add in the system and have make sure it's, hey, if they have a large loss that you haven't been able to realize all the income from, to offset it, then you can definitely put that in your tax tab in the settings section.
Yep, that's a great point too, especially when you're talking about capital loss carryover. If that is applicable, just like Derek said, you can enter that right into RightCapital to make sure we are accounting for that important factor for tax calculations. We are pretty comprehensive in our tax calculations. So those are all nuances that when you have that information or you see that kind of flag waving that something happened in the past that you want to ensure is, of course, captured in the future and how that's going to impact future tax calculations. That's a great way to, when we have the 1040 or that information, you can plug that into RightCapital in terms of we can enter that capital loss carryover that's applicable. We're talking about rental properties of putting that depreciation, but those tax assumptions that can be found in that gear icon is pretty vital in terms of setting what you know as the current plan for the client. So it's all really, really, really great points, but this is kind of leading towards the end of our time here, but there is an important thing to be considering when you guys as advisors are using a platform like RightCapital. There's a lot of nuances to the system, as we've been discussing. It's pretty comprehensive in tax calculations, the 1040s, things like that. What do you guys lean on as a resource within RightCapital in terms of getting questions answered? Warren, if you want to kind of lead the discussion of what do you typically do? Do you call into the helpline, or do you typically use the chat feature? Do you leverage both, or do you schedule time with
I call probably like 4 or 5 times a week. It's so crazy that 3 years into using this software, there's still little things that I'm learning all the time. It's so cool. And what's even cooler is that the people who answer the phone on the other end in RightCapital, they are like so knowledgeable on the system. It's like they don't get on the phone until they've got a CFP or something. You know what I mean? Like they're so good. The bench is so deep. I love everybody. I love all the surveys you give after the call. And then, yeah, I mean, if I think of something after hours, I'm just going to do either I think a Loom video actually be cool for that too. But I've just been doing snips and sending those into the chat function, and then someone calls me back. I just put on I'm like, can you please call my cell, 714, not going to say the rest. But they do it. It's pretty cool.
Yeah, no, absolutely. And yeah, definitely if it's after hours, just so everyone knows, the support team's always available. I wish 24/7, but it's available 9 to 6 p.m. Eastern weekdays. So if there's ever a time where you ask questions offline, you can always shoot them an email at their email, support@rightcapital.com, or you can always use that chat feature to leave a message and they'll respond first thing in the morning. But Derek, do you think that that's the similar experience for you? Do you typically leverage the immediate phone call, or do you book a lot of time?
I'm more of a 60-40 call versus the chat, but usually the chat's like a quick question, like, hey, I'm just like stuck on this one thing. Like, what am I missing? And it's like, oh, now I'm an idiot because I should have seen this. But I mean, the nice thing about RightCapital is they're always updating stuff. The challenging thing is like they're always updating stuff, right? So you want to just make sure you stay on top of it. So that's where I find, especially leveraging the calls and calling them and talking to actual people and walking through like, hey, what if I did this versus this? It's just good to really kind of make sure you're not missing something or getting that extra help. Like Warren said, the hold times are like minimal, and then the people are always very knowledgeable.
Yeah, no, all fantastic points. But the reason why I bring it up is because there's no limit to how many times you can reach out. If you've got questions when you're doing data entry in general, this is of course for the advisors on the call, you have a fantastic support team available to answer your questions, especially as you're having meetings and if you're trying to have those conversations about what is happening with their cash flows for their tax payments. It's a great opportunity to ask questions, and don't hesitate to reach out to them. It's all real life people. You can give them a phone call. You can book some dedicated time to do a case review with them. You also have a fantastic help center as a resource as well, where you're going to find a lot of articles that walk through the different modules with written instructions on how to do some of this data entry, but also a lot of our videos and our webinars as well. So you can always watch those recorded webinars. I do see a couple questions of, is this webinar recorded? This is also a recorded webinar. So no worries there, but you also have a lot of other content you can always binge watch over the weekend if you guys are bored. Feel free to leverage our help center as another resource and at least a new free streaming service for RightCapital content at least. But I want to thank everyone so much for joining us today. I really want to give a big shout out and a big thank you from RightCapital to Warren and Derek for joining us for today's conversation on navigating those difficult conversations with clients of tax planning and all those nuances. So thank you so much for joining us. I hope everyone has a fantastic weekend. I hope you enjoy the Great Wolf Lodge for all of us, Warren. So take your RightCapital gear and just have a blast. And thank you so much.
I'm going straight to the wolf's tail with the RightCapital gear on.
Give a shout out to RightCapital when you go down.
I will.
Perfect. Well, thank you so much, everyone. Take care and have a fantastic weekend.
All right. Thanks a lot.
Thank you for joining us.